But we want to go a little bit on the outskirts of FinTech now to InsurTech. And I would like to introduce the moderator of the next panel, who is Larissa Vaughan, the acting CEO of Kiwibank Insurance. And I think Larissa is very, very capable of leading this conversation. I mean, first of all, see her background at Kiwibank Insurance, but secondly, she actually has her trade or her career started in the legal aspect of the financial sector, working in legal departments of large financial institutions and banks in Europe and in New Zealand before, in 2018, making the move to, should I say, the dark side, or to actually working on the insurance side as the acting CEO. So I let Larissa introduce her panel, but please keep it interactive again, for questions.
Good afternoon. It's probably fair to say that insurance is not normally thought of as a fast-moving or particularly futuristic industry, and perhaps it's better known for its maybe obsession with mortality rates and policy fine print than agility and speed. But InsurTech is shaking things up, and it's moving the conversation beyond death rates and documents to digitally delivering tailored protection for customers for everything they care about, whether that be their teeth or their phones, and occasionally their lives. So on today's panel, we have Ian Pollard, CEO of Delta Insurance. They're in the lovely blue suit at the end. Michael Lovegrove, here, CEO of JRNY. Andy Coon, co-founder Cove Insurance, and Kevin Whitmore, Business Innovation Advisor from Callaghan Innovation. Our panellists today, we're going to be discussing the insurance company of the future. Radical transformation and innovation in the insurance industry is driving change. And our panel are going to discuss if it will also drive greater accessibility and making insurance more personalised through an inclusive and simplified approach. So we're going to maybe start off at kind of a macro level here, and I'm going to turn to Ian to kick this off about the main trends in the industry and InsurTech in New Zealand and overseas.
Thank you, Larissa. I think probably the sort of three key trends that certainly I've seen over the last few years. The first one is that the sort of, I guess, the InsurTech revolution over the last sort of 2 or 3 years hasn't happened in isolation with just InsurTech firms or tech firms. It's actually happened in collaboration between InsurTech and, I guess, well-established incumbent insurance companies. And I guess certainly myself and Delta, we're kind of testament to that. We're doing a lot of stuff at the back end from a technology perspective, but as a Lloyd's cover holder, we plugged into the Lloyd's community, and we're partnering with a number of quite well-established insurance companies in the Lloyd's insurance market. I think the same goes for Andy as well. He's also and Cove are also a Lloyd's cover holder. So probably more to the extent Andy is providing more sort of sexy technology solutions than we are. But I think that's kind of part of the theme, and I think that's the same when you look at some of the large global InsurTech success stories, the likes of Lemonade. They've got a number of large reinsurers sitting behind them who are very well-established insurance companies globally, been around for hundreds of years. So I think the first one is that collaboration. I think the second one is certainly at this point in time, a lot of the InsurTech trends have evolved around the back office as opposed to the front office. And again, talking to that from our own personal sort of experiences at Delta, whereby we built everything from our claims and underwriting system fully in the cloud to fully help us, I guess, successfully get to really good customer outcomes and really quick policy issuance, really quick quoting to brokers in this sort of commercial specialty insurance space that we play in. But we haven't, truly seen, I think, the radical innovations at the front end. And I think Mike and Andy will probably disagree with me to that respect. But I think the back end or the back end sort of systems are really sort of, I guess, to this point in time, generating a lot of the InsurTech opportunities globally. And I guess the third main one as well is that InsurTech, I guess, is a subset of FinTech, has seen a huge amount of investment activity over the last couple of years. And I think to the point that this year, InsurTech funding is likely to hit the $6 billion mark. I read a statistic the other day. That's vastly up on what it was last year. And interestingly, a lot of the InsurTech investments are being made largely in continental Europe. And I think half of the top 10 InsurTech raises were actually in Berlin in 2018. So they're kind of some of the macro trends that I'm seeing. I don't want to steal everyone's thunder, so I'll hand it over to somebody else.
Yeah, so how about some of the maybe the more micro trends kind of at the front end? Maybe that's a question for Andy and Michael.
Yeah, I mean, what we've seen probably this year have been, particularly in the New Zealand, even Australian and Singapore markets, have been a much larger desire to partner with InsurTechs or technology vendors rather than trying to build something themselves. And that partnership model is something that allows both the InsurTech and the incumbent to succeed. So that, I mean, JRNY, we are a distribution platform. We're a software provider for insurers. And so that's, from putting the JRNY lens on, that's what we've seen.
How about you, Andy?
Yeah, I think it's quite similar to what Mike's saying and what Ian said. So we have partnered up with Allied World and Lloyd's in order to do our business, and that's really their way of getting into InsurTech, because it allows them to hedge against it or have some exposure to it without necessarily lunging into areas they're not that competent at. So insurers sometimes have had some bad experiences with IT projects, and they haven't wanted to dive into a project that's quite IT focused, or things like design and UX and customer experience is not necessarily in their DNA, where it's more about policy design and underwriting. So the partnership model seems to be pretty common. And yeah, when we were up at Singapore FinTech Festival, huge number of providers to choose from for the insurers to help and get out there.
Right, so outsourcing their risk and innovation to some extent. And moving, I guess, from kind of industry trends and thinking about millennials, I'm going to have to turn to the self-identified millennials on the panel, Andy and Michael, in terms of I'm thinking about millennials and even how they engage with insurance and how they value insurance, and probably fair to say that they do that in a way that's different to how their parents might have done. And there are a number of reasons for that, demographics, home ownership trends, and digital sort of savviness. So how will InsurTech help millennials engage with insurance, and how will it be different?
I'll have a go. Yeah, so there's a few things in there. One is that, like you called out, the asset base. So people aren't buying a home quite as early. They're not buying whiteware. They're not necessarily accumulating $40,000 of durable goods. So that was something that we tried to lunge into with our phone insurance product. It was recognising that for a lot of people, buying a $2,500 phone was the most expensive thing they bought. They've got that, they've got their car, and other than that, they just have clothes from H&M that they don't care about. So it allows you, and we'll talk about inclusivity later, but for people, they could get in with an entry-level product that cost them $10-15 a month instead of 30, and actually get into the industry. So that's kind of the positive side of it. The negative side of it is, I think it's fair to say millennials expect something back for their money, and when you're doing insurance, that's not actually how it works. You might get something back, but you actually might not break your phone. So you have to bear that in mind when you're designing the products, is that, when people end their policy, they say, can I have my premiums back because nothing happened? You're like, no. So, you can kind of look at it and say that's ridiculous, or you can actually design a product that does that. And so, we're looking to change our product subtly, and at the end of the term, you have the option to trade in your phone, and we'll give you slightly more than you'd get on the open market for it. That allows us to have feedstock to then use for the insurance, so it works for us, and the customer feels like they're getting a bit of value. So I think if you can design a product that feels like it's actually got value no matter what, it appeals to that market. And then otherwise, if you don't, then you lean into this behaviour where they're expecting something. And then I think we were selling a lot more of the insurance through the chatbot. That does skew quite young. And so that the new ways of engaging with people is something that brings some of those people off the fence.
Right, so you've got the different engagement model and probably the different value proposition as well. And how about you, Michael?
Well, I was going to say, even like it's almost coming from the other angle as well, that millennials have a different way of purchasing. They're pretty, what's the word I'm looking for actually? It's on the tip of my tongue, but it's gone. But you know, they want it now. So they're impatient. Millennials are impatient. And so how we've typically purchased insurance, it's taken a lot longer than, say, other industries have to make a purchase. And so actually changing that purchasing model for the millennials, I think is pretty key to making sure that they are insured, because the overarching big problem that we have is that the world itself is massively underinsured. And so how do we make sure that people actually become insured? One is to make sure that they actually, we sell the right insurance products. And the second one is to make sure that we're selling to these people in the right way, so that they actually want to purchase and that they're in the right channels. So from a distribution perspective, some people may have heard of the do you want fries with that? As that's how they're talking about insurance. So you will see insurance providers that are non-typical or particular organisations that are now selling insurance that 10 years ago they weren't selling insurance. And that's because that's just where the customer is, and actually being where they are is going to be pivotal to making sure that we actually insure the population that are coming through.
A sort of point of sale purchase. Yeah, it's interesting to think like that impatience to think about life insurance, and not only is the buy process delayed or longer, but the benefit, the perceived benefit is indefinitely, delayed, which is quite a mindset change. Yeah.
I think there's probably just one other thing to add as well, and that's the assumption that the previous generation actually did understand insurance products better. I think there's just a general shift in better UX, better usability, better understanding of products in general, and that's something that we're seeing across the board being beneficial.
Look, I think that's a good call out, Kevin, and I think, possibly not a case, maybe they understood it better, maybe they were more happy to rely on an expert trusted advisor, and to use, put their trust in somebody else to source it for them and trust that was going to work, whereas maybe that level of trust and the way people want to engage is different, which comes to your point about the upfront experience and how they engage. And possibly trusting more actually in a digital experience than a trusted person. And thinking about the tech industry and the insurance industry, and maybe this is fair or unfair, but it seems that insurance has been a bit slow to the tech start line. Do you have any thoughts on why that's been and what some of the challenges have been? And that might be a question for Kevin and for Ian.
I don't think insurance has necessarily been that much slower than, it feels like that, but I think obviously the nature of the product, when I worked for Allianz in Japan, for example, we brought out some new annuity products, but there was a big shift there was a problem with trust and that perceived risk. So even though the brand was German, which resonated with the Japanese audience, there was a tendency to stay with whole life products as opposed to going with something that they didn't properly understand. So I think the nature of the product itself being trust-based and tending towards risk aversity does create that sort of slowness as well. But you see that in a lot of other industries as well. We see that with travel. Their systems have still been around since the 60s, a lot of them in terms of their back-end systems. So I think it has been slow, but I think it's also probably unfair to say that it's pointed out as an irregularity.
First-hand experience, having worked for a major global insurer whose name might be on the All Blacks jersey. But major issue at global insurance companies, from my experience, is legacy systems. They're so reliant on them. They're not really that interconnected, but they're reliant on a hodgepodge of legacy systems that they can't move away from because they retain all of their core data. I think it's probably more advanced I guess the insurtech phenomenon is more advanced in the personal lines and possibly even in the life space and maybe even in the employee benefit space. But when you get to the commercial specialty space that we certainly operate in, we kind of run rings around our competitors with some pretty basic tech that sits behind our proposition, which allows us to get to market quicker. We're not doing anything much more sexy than that. It just allows us to quote stuff very quickly. So I think the commercial insurance space is probably even further behind the personal line space. I think the other thing as well is probably key to most of the certainly larger or global insurers. Most of them are running on insurance margins that are, or profitability margins that are wafer thin at the moment, especially in the current, I guess, CAT and also low investment yield environment that a lot of insurers are looking at what they're looking to do long term. A lot of them are running at, and high-fiving themselves if they're running at a 99% combined ratio, which, I mean, Larissa will know what that means very well, but that's a 1% profit on everything that you're doing. So what that means effectively is that you're hamstrung on what you can invest in new projects as a large insurance business. The other side of it is, with that 1% profit margin, is a huge amount of risk if you envelop on a massive technology project to re-engineer all of your processes over the 150 countries that you may or may not operate in. So they're not willing to do it. So they then revert to API type projects that will actually only paper over the cracks. Then if you start to look at some of the newer incumbent insurance companies that are coming into the markets, the Lemonades of this world in the States and some of the other entities, they're running at expense ratios of sort of 10 to 15%, whereas the sort of traditional players with their acquisition and distribution base are running at sort of 35 to 40% acquisition base. So it starts to stack that makes the future certainly ripe for innovation from pure and new insurtechs.
Yeah, I think it's interesting, and also the different kind of, I guess, tiering and speeds of the different products. And I think certainly one of the slightly unique challenges with the life book certainly is maybe, unlike other products, you've got to maintain those legacy books. Unlike, say, managed funds or banking products or other financial products, you can't just switch them over or consolidate. You have to maintain that book, which also I think also means people maybe are slower to launch new products because you're going to be stuck with whatever you've built, which makes things heavy.
Yeah, absolutely. I think that's a big part of it because you are stuck to that retention, and that retention, so you stick with what you did before. Yeah. Exactly. Yeah.
Look, and just before we move on, I just want to pause in case there are any questions from the floor. One over there.
Yeah, I was kind of struck, partly because I come from Thailand, so the regime there may be a little bit different, but I was struck by that there was no real mention about the regulatory environment and its impact on innovation and product development and so on. And I'd be curious as to whether or not that's because there's no real impediment in what you see in that space, or whether you have a different view on that.
It's a great segue actually to our next topic, so we might move to that one because it certainly is a live topic here. And if anyone's seen the FMA RBNZ press release this morning on the life insurance industry, which I have almost copied and to heart, but I'll talk to Michael about that because I think it's really interesting to think about the regulatory environment and whether that is better responded to by insurtech possibly than incumbents.
Yeah, I mean that's a massive part to where the landscape is going, or sort of what's happened over the last 8 to 9 months and going forward. And actually, it's been like the regulation change, or the Royal Commission report has been a massive influence for insurers to change and to make sure that they're fundamentally selling the right policy to the right person at the right point in their life, and as their life changes, that their insurance policy changes with them. And so, we always want people or consumers to have the right policy based on who they are. Now, that's really hard to do. So what we've found is that incumbents are turning to us to help them to do that because our technology can help them do that very thing. But that's like a regulation, I think, is almost at the crux of why the industry is changing now. Right? I think that's actually why there is change and why InsurTech is starting to become a much bigger thing, why you'll see investment over the next year or two exponentially increase in comparison to previous years, is because InsurTechs are able to make sure that the incumbents are compliant with regulation.
Did that help answer the question, or?
Well, I guess it was a little bit more maybe open-ended because I've as I said, the places that I'm familiar with, and not Singapore specifically, obviously, but where you have a different insurance regulator versus the banking regulator, and you see a different attitude towards product innovation, towards new entrants, towards unbundling, et cetera. And so it has been, I don't know if that experience is similar in this jurisdiction, but the ability to introduce new products that are suited to the change in the way actually people need to be protected from the traditional ways. It has been rather slow because they have to have the process to get them new products approved and priced and so on has not actually changed at all. And that's been one of the things that I was curious whether or not from the product development side, product innovation side, there's been any impact as opposed to sort of the other aspects of InsurTech.
Yeah, I think I kind of follow what you mean, because I have some experience running an Asia Pac business in a prior life, and when we had to launch, for example, we launched a cyber insurance product. I think it was Thailand was always one of the last places that we launched it, because you had to file it, translate it, had to go through the process with the local regulator, and then it was open up in theory to others to use that product as well in the local market. I think it's slightly different, certainly in New Zealand and probably also in Singapore, certainly in the commercial space that I work in. You go through your own internal due diligence, and your focus is actually, and the focus is even more exacerbated now with the Royal Commission in this part of the world, is on the customer outcome, ensuring that you've got the right customer outcome as opposed to necessarily having to file the wording with a regulator or anything like that. So that's where these guys, I think, have got a huge opportunity, especially in the personal lines and potentially even in the broader space, because it's all about customer outcome, and that's certainly what's driving what we're doing in our space as well.
I agree. I mean, I think the ability to be agile and to identify customer need and to respond to it quickly should be helpful. I mean, we basically have a licensed entity system here as a life insurer, but we don't have to go through a per product approval process. Yep. But it does need to be aligned with good customer outcomes. We need to have to prove that throughout the customer life cycle. I'm going to turn now, I guess, and I think it's a related topic, which is around accessibility and inclusion. And whether the question is, does InsurTech help or hinder access to insurance? And for example, if you think about the increased personalisation of products and data availability, does it actually mean less sharing of risk? So for example, if you think about some of the medical conditions and DNA testing that can be done now, does that mean that some people might ultimately be excluded from cover? Or even if you think about data around, I don't know, traffic accidents and things like that, and tracking your how you use your car. So just interested in terms that, does InsurTech help that? Does it hurt it?
Yeah, I'll grab that one.
Yeah.
So I think there's different parts of InsurTech that do different things. So one part that's really, really helpful is that low cost to serve. So we're talking before about having a $10, $15 premium product. Like, that's quite difficult to do if you expect the customers to call you, if you expect to have a half an hour conversation about it. You can't bury that cost quite as easily. So I think it does actually add a lot of this micro-insurance and get people into the game. So it's very, very helpful from that front. But then I think where you're going with that is that personalisation piece can be quite harmful. And it's probably a place where government has a role. So when you get into things like that we do, Ian mentioned before that it's thin margin. So the difference between getting a couple of fraud claims that make it through or a couple that you're actually successfully able to block out because they're genuine fraud, that can be quite difficult, because if you do it at underwriting, the people who look like they're about to do fraud might just be people who don't really understand insurance or who are a bit poorer. So So then those people get, can get blocked out as well. So you need to be quite careful how you do it. So we introduced some technology recently for people who are currently uninsured and have no reason to be uninsured but wanted to buy insurance. Now that could be a person making a really good financial decision for their life, or it could be a person who had a crash 2 weeks ago and wants it to get fixed for $50. So you need to get a handle on which camp they fall into. So you just use a smartphone, get them to record a video of their car, and then you're sweet. So that's an example of where InsurTech means good outcomes for everyone. But then when you get into, say, the DNA stuff, like the health insurance is where it gets really contentious, because if you don't insure someone, they might die. And so I think where I used to live in Ireland, everyone pays exactly the same for health insurance, and you need to get into it before you're 32 or something. But as long as you do, insurance just costs you a certain amount, and then it goes right through. Now that system's flawed in its own way because all sorts of reasons. But I think if you go too far out of it, and Wellington's a pretty good example of where insurers don't really want to touch it at the moment for the earthquake risk. And people like Tower are now really forcing the market into risk rating a bit more effectively. If the government doesn't step in, then you're going to be paying $30,000, $40,000 a year for insurance here, and it becomes unaffordable. Like if you'd known that 500 years ago, maybe you wouldn't have settled on the fault line, but everyone has. So I think it's quite interesting, and if you do something like what Ireland did, it makes it difficult for the insurance industry to operate. They had problems with Obamacare and those ones, is that insurers just try to de facto get back to where they were and make sure the people who have pre-existing conditions don't turn up. But if you actually have a sort of a cap and collar and have the government administering a scheme, something like that could work, where you actually force the market back into a risk-sharing basis, but somehow do it behind the scenes in a way that still works for the market. So, and I think InsurTech can be quite helpful in actually understanding that along the way.
Any other thoughts on that from the floor or the panel?
Yeah, I think I was just thinking then about, we've just recently launched, we've been in the sort of cyber insurance and commercial specialty insurance game, tech insurance, etc., for 5 years since we started here in New Zealand. But we just recently launched a personal or household cyber product, and the kind of key piece that we were struggling with was data. We didn't have enough data to actually sort of understand the risk, and also help households understand the risk and what they should be doing. And we teamed up with a cyber entity out of the UK who have a rich amount of data from the dark web, which helps us and them also identify people who have their credentials in the dark web. And this data is just increasing exponentially. And it actually helped us make the decision to push forward with the product. It actually makes us a lot more comfortable about providing a tangible service to individuals and their householders as to protecting themselves, not just buying an insurance product, providing them something and the tools to actually sort of improve their passwords, etc., because there's tangible information sitting behind it. So this actually prompted us to launch the product about a month ago. So that sort of getting access to data like that can help you as an insurer fulfill a need in the marketplace, or fulfill a need that's unserved to date.
Interesting. Any comments or questions from the floor on that? Yes.
One of the learnings we had in Singapore, part of our sandbox, one of the experiment we did with which company? I think it is with Aviva. So we experimented with the InsurTech company, and the idea was to test a real-time claim processing for a use case where women get almost 30% of women have a chance of getting gestational diabetes during pregnancy. And this was an experiment. We worked with hospitals and the insurance company and the InsurTech to real-time monitor when they go for pregnancy check, and at the point of detection, there's an instant claim processing over a blockchain network. The experiment, out of the 7 sandbox use case, this use case, when they came out of sandbox, they did not scale. They did not pursue the idea. in a way, it was one of the cases where the sandbox failed. And the reason it failed because, unlike other industry, insurance industry needs to depend on other sectors. In this case, it was the hospital and the medical sector which perhaps did not align themselves with the end-to-end use case. While the financial sector was willing to work and give the regulatory support to do this instant claim settlement based on a instant detection of a clinical situation, the hospitals and the hospital sector was not ready. Do you think as one of the impediment for InsurTech will be a gap between the regulated medical sector and the financial sector, which may come as on the way of innovating in this space?
I'm personally going to struggle to answer because we don't focus on the health insurance space.
I mean, whether health insurance or a travel insurance or you are dealing with multiple sectors to make a comprehensive product.
We're not going to have a stab at our experience because we do get medical information from people, and in New Zealand there's no one source of truth for that medical information. There are ways you can get it, and if GPs, because we're talking about general practitioners often, if we need to get medical information from them, there are ways we can get it, but it really does depend on whether or not a GP is signed up for this particular information service, and also how engaged they are with that service and the timeliness in which they would respond to it. So there's not one source of truth for medical information, and we also find people go to multiple medical practitioners. If they're new to New Zealand, they don't have medical information here. So for us, the challenge often is actually getting timely, relevant medical information, because there's no one easy way for us to reliably get that at the moment.
Yep. I think actually I was in Singapore last week and spent some time with Rosalind Chow at CXA, whose bugbear is focusing on that sector, the time lag between the financial institution and the medical treatment. And she's trying to remove the complexities in the middle. So I was fascinated by her story, and I think Singapore's slightly different to here because there might be a slightly less intermediation here in the sector because we've got Southern Cross and a few other players in that space. Don't want to pick them out. So I think it's probably, the process is probably less complex here. I think some of the sort of technologies in that space have ramped up pretty quickly, whereas I think certainly it seems to me in Singapore that and probably broader Asia, she was fulfilling a need to condense that process and satisfy that need between those different parties, which I thought was very exciting. And we're talking to her about plugging some of our cyber products into that mix.
I use the medical as an example, but I think when insurance applies to other non-life sectors,
it can.
The cross-regulatory alignment can become a key gap for insurance.
Yep.
Was it purely regulatory, or was it also alignment in terms of who had a problem?
There was a disclosure and there's a provenance of certain data, how to ensure that the particular GP detection is a golden source of truth. So there's a whole set of complex policy barrier came in as part of the learning. Great experiment, we supported the experiment, but it was some other sector which caused that product not to scale.
No, so I'm just thinking, because we had a scenario in New Zealand where DHB actually started with the problem, and then they brought in the technology provider to help to unlock it, and there was already automatic buy-in from that specific DHB to unlock the problem. It might be different when you're starting with the InsurTech company and then going to the hospital to try and make it their problem. Could be another scenario.
We had a very basic challenge of how to ensure the doctor actually detected the right thing. Because the claim was supposed to be instant based on the detection of that particular clinical situation.
We have an even more low-tech one, which is if you crash your car, you'd like to instantly find out the calendar of all the nearby panel beaters and book a time, but that requires all of the panel beaters to use the calendar. And if you've been to a panel beater, a lot of them, the computer's this beaten up thing in the corner that doesn't get used. And so there's a huge training for a lot of them. A lot of the more modern ones, you can have the conversation, but it's a challenge.
Yeah, I noticed some of the bigger players in Auckland too have actually been bringing in-house their own car repair services, I think, because of that very issue. So as you say, kind of quite mundane, but still really challenging.
Thank you for that. But I was trying to push you, given what I'm hearing, New Zealand is very strong on sustainability, climate change. There's a huge insurance opportunity, insurtech opportunity coming from that sector. I'd like to know what New Zealand is doing on that sector from an insurance industry. Because one way to manage climate change is to price it to insurance, which I don't agree, but actually that's what the current thought process has been.
That's a big question. Who wants to try and tackle that one?
Well, it's probably not what you want to hear, but we're at Delta, we're actually currently providing insurance products in the commercial space for environmental and pollution risk, either on a single site basis or on a broader, I guess, all risks basis, whether it's a construction firm or a transportation firm. That's commercial risk. Now, that kind of sounds counterintuitive, i.e. we're insuring for pollution. But if you sort of take the analogy of insuring a house, we're actually, with sprinkler systems in it and detection systems and alarm systems, we're requiring that of the firms that we're insuring. We're requiring very good risk management, that they're not going to have a pollution spill. So in our own little world, in the commercial world, we've done that, and we were the first to do it here in New Zealand, and that's not unusual. There's similar products in the Asia market. But in terms of climate change, insuring against rising sea levels, I think things like that. I think that's a problem that the insurance market is still grappling with. I think it's
Yeah, I mean, I would refer to some of the things, and I think the Insurance Council in New Zealand is beginning to grapple with that in terms of property insurance and risk-based pricing, and what that means for various populations in New Zealand. So it is a big and very live question, especially here in Wellington. Yeah. Look, a good question, but conscious of time. And one topic I did want to touch on before we wrap up today was, I guess, about Kiwi companies and expanding into Singapore and Asia, and some of the market differences, and what are some of the ways that New Zealand companies can succeed and how set themselves up to succeed there. And I might start with Kevin on that, because I know he's got some thoughts on it.
So I guess I started up a FinTech company. It was exclusively dealing with cost management, expense management for banks in Singapore. So we set up, our headquarters was in Singapore. We ran it for 5 years. Just from a Kiwi's perspective, very easy to do business, to Hayley's point before, in terms of how accessible it was to other markets. We were able to expand into Japan and other areas pretty quickly. I think we also had a success story with 8Wire. So we've just heard that they've, after 12 months of going to the Singapore FinTech Festival, they've just signed with KPMG to do the automated regulatory reporting for KPMG's banks in Singapore. So just from a business perspective, very conducive to operating there. We thought it was a fantastic market to do business in.
Great. Other thoughts from the panel, Ian?
We've been in Singapore. Delta Insurance has been in Singapore for 2 years now. We were established as the first Lloyd's cover holder there in 2017. We've been here. We've been in New Zealand and headquartered in New Zealand since 2014, actually. We saw it as our first obvious move overseas. Before going across the Tasman, we saw the opportunity broader across the Asia region. We're doing business in Singapore, doing business in Hong Kong. We're now doing some business on a reinsurance basis in Vietnam, Taiwan. We're looking at Cambodia, Indonesia. And I think one of the themes that came out earlier in the piece was about Singapore being a hub for the region. That's very much what we saw it as. I think if you are going to look at doing business in Singapore, you've got to be on the ground there. You've got to have an operation there. You've got to have local partnerships. You've got to have local tie-ups. That's very, very much key. That's been very central to what we've done. And also, I think probably a key one as well is that NZT have been invaluable alongside Lloyd's of London as well. So we're part of Lloyd's of London. But both NZT and Lloyd's have been invaluable in their support for us getting off the ground in Singapore and been a huge help to us from the point that we had our sort of launch events at NZT's offices to the amount of support they give us on an ongoing basis at FinTech festivals, etc. And fantastic FinTech events. Well, we've had presence at all 4. We've exhibited at the last 3. We're at the first one, so we're looking forward to going again for the 3rd time. Sorry.
Just want to add to that around the NZTE comment. I mean, for us, probably March this year was when we went across, we presented at Money 2020, we were ranked as one of the top 2 FinTech startups in Asia Pacific. And NZTE were there along the whole way for that. And on the back of that, they've introduced us to a bunch of different insurers or banks that distribute insurance in Singapore. And they've been able to advance those conversations really quickly because they've got a good relationship with insurers in that location. And I find that, and this might just be my personal experience, but it sounds like Ian, you've had the same thing, where doing business in Singapore is really easy. And I think that maybe as a Kiwi, we are received well, I think.
Look, thanks, everyone. We'll wrap it up there. I do want to thank the panel today and some great thoughts there, I think, around some of the challenges and opportunities in InsurTech. Some key themes to me have been around collaboration, globalisation, and accessibility, and then some of the changing kind of regulatory and environmental factors as well, which InsurTech seems well placed to at least help answer in a different way. Thanks very much, everyone, and thank you for the questions from the floor.